This is from a guy that's very successful. The point of it is that no, I don't think it will hurt gold and silver. I think it will hurt the broader market. My guess is it would be somewhere in the $70 range. Look, I think the fact that it held the $60 level, and then every time we get in the 60s, there's big buying, someone stepping in and buying. And that's why Van Eck funds came out and said, if the dollar lost reserve status, gold could go to 139,000. That was the number they came up with. That's not me, that's Van Eck. So you sell a $20 million bond due in 20 years, right now it's 4,500 ounces. At $139,000, it's 120 or 30 ounces. Not only could you have zero upfront borrowing costs when you sell those bonds.
Not saying, because I love the interview that you had with Michael Oliver, I thought it was great. Big kahunas. He's still sticking to 300, 500.
I don't think COMEX will default. They'll change the rules, keep it from defaulting. They could force majeure, which is the same thing as a default, but I would assume they would still offer the service.
We're talking about AI and we're talking about the SpaceX IPO, Anthropic potentially IPOing, OpenAI. Do you see that impacting gold?
And Andy, can you comment about Fox Business reporting that silver demand is exploding and the U.S. has the richest mine in the world, Silver Valley?
I haven't heard that from Fox News. I would love to see that, and where they're getting their information that silver demand is exploding. It has to be at the highest levels, because at the highest levels, we are seeing demand for silver increase dramatically. Look at China over the first quarter, bought more silver, imported more silver than in the history of the country. And you're seeing that on a very large scale. We're seeing huge deliveries on COMEX. At that level, silver demand is very, very high. At the retail level, people are still asleep. You guys aren't, but most of the people that you call friends and family are. So no, I haven't seen that. But look, when you have a domestic mine, this would be part of the Project Vault, which would be to develop a strategic stockpile and putting a price floor under the price of silver to bring forth companies like this that are domestic and that can
and
incentivize mining, no matter how uneconomical it is.
And remember, with the silver mines, and it might be an enormous find in Silver Valley, but remember that even still, 75 or thereabout percent of all silver that we get is not from silver mines itself. It's the byproduct of mining for other metals.
Mostly copper, lead, and zinc.
Correct. Right. So, unless we are going out and we are increasing capacity to mine those metals exponentially, you're not going to see a substantial amount more silver.
That's why they would implement price floors to incentivize domestic mining that has been uneconomic.
Markets celebrate new discoveries while ignoring the uncomfortable math behind actual supply growth. As Andy Schectman points out here, record imports and delivery activity matter less than headlines about a single mine, because most silver production still depends on copper, lead, and zinc economics. That raises a harder question. If governments discuss strategic stockpiles and pricing support, are they preparing for shortage rather than abundance? Savers who assume supply automatically expands with price may discover the market is tighter than expected. Next, Andy Schectman exposes the one metric central banks are watching that proves they expect a devaluation cycle, not deflation.
One of the questions that we have here from Douglas Raoult, X1P, who's hoping for an update on the price floor for silver. I don't have an update.
No, there hasn't been.
There hasn't been one yet.
My guess is it would be somewhere in the $70 range. I mean, it certainly, look, I think the fact that it held the $60 level, and then every time we get in the 60s, there's big buying, someone stepping in and buying. The fact that it shot right back up into the 70 range tells you that there are people buying at these levels, that they think that there's good value here. My guess is that would be somewhere around where they would place the floors, but I don't know.
I think that would be around a $75, even though we're still below it today. I do think, and there's something inside of me that truly believes that we are going to end this year substantially higher than we are now. Like I really do, in my heart of hearts, in my gut, think that, not saying, because I love the interview that you had with Michael Oliver, I thought it was great. And he's still steadfast.
Yeah,
he does. I mean, you're talking about, big big kahunas, that he's still sticking to 300, 500. And I always say you can't get to 300 without 100 or 200 in front of it. But I do think that we will be seeing triple digits by the end of the year. And I think that when we do, I don't think that we're just going to be kind of on the surface of it. I think that we're going to way surpass it. I think that when we look back in January when it did it, it was much more momentum driven.
Price ceilings get attention, but price floors reveal who is quietly defending the market underneath. According to Andy Schectman, repeated buying around key levels signals conviction. The current pricing does not reflect future scarcity expectations. But momentum and structural repricing are not the same thing, and investors who confuse speculative spikes with institutional accumulation often enter too late. Wealth preservation starts by watching who absorbs selling pressure, not who makes the loudest forecasts. Next, Andy Schectman unravels why their public narrative about supply requires three contradictions to work.
Much more FOMO driven. Everyone they were talking about it. They were talking about it on CNBC. They were talking about it on Bloomberg. They were talking about it on these financial networks. Then they started talking about how overbought and overvalued it was. And
speaking of making predictions that I never do, Michelle held my feet to the fire today and asked me, because a lot of the things that I've been talking about bringing back manufacturing, the Genius Act, the role that gold will play in all of this are starting to come true, and which is kind of nuts to me. A lot of it is coming true, and when I saw this new guy, what's his first name, Paul Winfrey, appointed as an advisor to the Fed Chairman Warsh, it made my day. Paul Winfrey is a guy, and he's an economist. He's worked with Trump. He's a smart dude, and he was one of the economists who wrote a chapter in Project 25. You can Google Project 25, see what it's all about. But he wrote, I think, Chapter 24, where he advocates for issuing gold-backed treasuries. Now, I think it's very interesting that he would be the first advisor appointed. Let me read you what he says. He says, beyond full backing, alternate paths to gold backing might involve gold convertible treasury instruments or allowing a parallel gold standard to operate temporarily along the current fiat dollar. Now, I don't think they'll do that. I think they will do the treasury. Ease adoption while minimizing disruptions, but they could be temporary so that we can quickly enjoy the benefits of gold's ability to police government spending.
The loudest market narratives usually appear after positioning is already underway. What Andy Schectman is highlighting isn't simply enthusiasm around gold. It's the timing of policy language appearing before public debate catches up. When advisors begin discussing convertibility and parallel systems, investors should ask whether financial architecture is being tested quietly before rollout. The risk isn't missing a rally, it's misunderstanding what institutions are preparing for beneath the headlines. Next, Andy Schectman reveals what the Fed's own meeting notes expose about gold, and it contradicts their public narrative entirely.
In addition, Congress could simply allow individuals to use commodity-backed money without fully replacing the current system. Well, you're seeing states allow that right now, Texas and Florida, whatnot. But I think that, as Judy says, if you use gold backing on a treasury, it would act as kind of the guide, if you will, the sounding board. The alarm would go off if your monetary policy was too stupid, because gold would continue to march higher, higher, higher. So having it back the treasury would not be the same thing as a gold-backed system where monetary policy is restrained due to the amount of gold you have. This would allow you to do both. And she asked me, what do you think the odds of Trump announcing a 50-year treasury backed by gold, like Judy Shelton has told both her and I when we did podcasts? I did one with Judy, she did one with Judy. Both cases, Judy said, yeah, Trump told me he's going to issue gold-backed treasuries, more or less, on July 4th. I said it would make my day for sure.
Make your day. You might put on a red cape.
Yeah, I'm not going to sleep July 3rd. I said I might even drink all night and stay up waiting for the announcement. If it happens, it'll be the greatest call I ever made. And it will tell me that we are on the path to maybe restoring manufacturing and giving our kids a future. If you haven't heard my thesis by now, it's everywhere. You can go back and listen to it. I'm the only one stupid enough to say it, but I believe it. And if it happens, we'll know. And I said, but if it does, I said 50-50.
When governments discuss preserving flexibility while introducing hard assets, investors should pay attention to the contradiction. Andy Schectman's argument suggests that commodity-linked Treasury ideas are less about returning to old monetary systems and more about restoring confidence without surrendering policy control. That distinction matters because savers often mistake symbolic backing for actual discipline. The portfolio question isn't whether announcements happen, it's whether incentives quietly change first. Next, Andy Schectman exposes the specific positioning tactic in COMEX reporting that hides true institutional demand.
And if it doesn't happen, I don't think it's end of story, but it would be amazing if he just got up there and said, you know, we're going to audit Fort Knox and maybe even tie something to a 50-year Treasury in honoring of the 250th anniversary. Something that's simple would, I think, change the entire narrative for the rest of the year for you and I, what we would talk about. But she said, what do you think the odds are? I said 50-50. And you know, I hate doing that. And that's 10 weeks out, 3 weeks out.
So let's say that is the case. And let's say that Trump does make the announcement. Does that lead you to believe that there will be a quote unquote revaluation of metal?
See, that's why I don't think you need to revalue. And that's why Bassett came out and said, we're not going to revalue it. If you use Tether, who their CEO is Bo Hines now on USA Tether, who is Trump's cryptos are, wink, wink, nod, nod, you guys are going to buy gold. Well, who's been buying all the gold? Oh, that's right. It's Tether. They bought more gold since the last 2 years than anyone but Poland. Well, you guys buy the gold with the interest you can't transfer out of the Clarity Act. You're going to push the dollar down so we can pay off our debt easier and sell manufacturing to the world. You're going to push gold higher, which devalues the dollar, but then also would allow the convertibility on the Treasury that you sell. By the time it gets out there, 20, 30, 40, 50 years, the price of gold is way higher.
The market keeps waiting for a dramatic reset, while incentives may already favor a slower repricing path. This is where Andy Schectman's thesis shifts from metal scarcity into monetary engineering, through debt structures and capital flows. The overlooked issue is that governments rarely announce revaluations. They create conditions that make markets do the work. Investors focused only on headlines, risk missing the mechanism that changes purchasing power underneath them. Next, Andy Schectman walks through the exact timeline when institutional money shifted from bonds to commodities, and why retail is always 18 months behind.
And that's why Van Eck funds came out and said, if the dollar lost reserve status, gold could go to 139,000. That was the number they came up with. That's not me, that's Van Eck. So you sell a $20 million bond due in 20 years. Right now it's 4,500 ounces. At $139,000, it's 120 or 30 ounces. A whole lot easier. Not only could you have zero upfront borrowing costs when you sell those bonds to rebuild manufacturing, but the constant appreciation of gold, where it's from the synthetic demand for U.S. Treasuries, but organically putting it into gold instead of the Fed doing it. By the way, as Tether does this and other institutions, maybe JP Morgan would do it, Wells Fargo, they'll all issue stablecoins.
They'll all jump on board.
It allows the government to accumulate gold by proxy. So it's not in everyone's face. The U.S. government's not doing it, but they buy it quietly from Tether, from JP.
Yep.
And so they build their gold stack. The price of gold goes to the moon. The dollar falls, which enables us to pay off our debt, sell manufacturing, reshore manufacturing. And when we have to make good on those bonds in 20, 30, 50 years, it's a fraction of the amount of gold we would otherwise have to give up today. To me, it's elegant. It works. And I told her, yeah, 50-50, I think it happens.
Well, I see Michelle is there, but I just want to get, Michelle, we're going to bring you on. I just want to get this one question asked while we're doing it. God bless you. Look at the light.
Yeah.
So Stuart Y7Y wants to know, when COMEX defaults, how will metals dealers hedge their inventory?
The official story says debt sustainability matters, yet every proposed solution seems to depend on weaker currency purchasing power. Andy Schectman notes that the overlooked mechanism may not be direct gold revaluation, but creating demand channels that gradually pull capital into hard assets over decades. That changes the conversation from price targets to monetary plumbing. Savers should care because policy shifts rarely announce themselves before portfolios feel them. Next, Andy Schectman unravels why their public narrative about supply requires three contradictions to work.
I don't think COMEX will default. I think they'll change the rules to keep it from defaulting. They could force majeure, which is the same thing as a default, but I would assume they would still offer the service. Let's hope anyway, because if they did, we couldn't.
Andy, we're talking about AI and we're talking about the SpaceX IPO and potential other, what we have, Anthropic potentially IPOing and OpenAI. And there's concern that this is going to suck the liquidity. This is going to suck all the energy out of every other space. Do you see that impacting gold? Now, I know the fundamentals, it shouldn't, and I know the macro fundamentals, it would be wrong to, but in terms of retail trade and in terms of some speculative interest, especially with regards to silver, because silver was acting a little bit like I hate to say it, but like a meme stock earlier. There was a lot of retail interest in it as we saw silver rise. And now people always want to know where they can put their money in for the quick ascent. I mean, I know it's been very hard for crypto. It's taken a lot of oxygen away from crypto and Bitcoin. Do you see that impacting the speculative trade side of silver?
I don't. I mean, I think crypto and Bitcoin are far more closely related to AI than is the precious metal sector. I don't. I think they're two opposing ideologies, and so I don't think it will. Quite to the contrary, I think what it will do, it will hurt a lot of perhaps some of the Mag 7.
Everyone watches where the markets crash, while almost nobody watches who gets protected when stress appears. According to Andy Schectman, rule changes and liquidity absorption matter more than dramatic default narratives, because institutions preserve system continuity first. The deeper question is whether speculative capital, rotating into AI, leaves other assets temporarily mispriced. Investors protecting wealth should separate narrative excitement from structural demand. Next, Andy Schectman reveals what the Fed's own meeting notes expose about gold, and it contradicts their public narrative entirely.
I think it could hurt Bitcoin. I think it would hurt the companies that have benefited tremendously from this rise. And interestingly enough, Kevin and I had breakfast with a hedge fund guy not too long ago who told us that he believed that the market would stay steady until those two stocks or those two IPOs came out, including the third being SpaceX, and then it would really take it on the chin. This is from a guy that's very successful. The point of it is that no, I don't think it will hurt gold and silver. I think it will hurt the broader market. And when you see a market that right now, you look at the Russell 2000 or the S&P 500, you have basically 10 stocks holding everything up. And you take those 10 stocks out or start pulling oxygen out of some of those 10 stocks, yeah, I think it could hurt the market far more than it would hurt precious metals, because the person that's buying Anthropic or SpaceX or Apple or Tesla or any, the Google, any of the alphabet stocks, they're not buying gold and silver, at least to my knowledge.
I think I'm kind of on the fence with this one, agreeing with you and somewhat being a little bit on the other side of things, because I think that there's no question that when OpenAI and Anthropic come out, those are going to be monster deals as well. You're talking both probably close to $1 trillion. So they're probably both going to raise. My guess is, what did we raise on SpaceX? How much did they raise? Was it 75? 70? No, it was more than 7. Was it 75 billion?
Markets often look strongest right before liquidity starts concentrating into fewer places. What Andy Schectman is highlighting is that broad index stability can hide dangerous dependence on a handful of crowded trades. If mega offerings absorb capital, weakness may appear where investors least expect it rather than where headlines point. Portfolio protection starts by asking which assets need continuous inflows to survive. Next, Andy Schectman exposes the one metric central banks are watching that proves they expect a devaluation cycle, not deflation.
What was it?
Something like that.
It was 555 million shares at 135. So what's that number? I don't think my calculator, I have to go that way on it.
75 billion.
75 billion, right? 555 million times 135. 75 billion.
Yeah.
So 75 billion, they did a raise for SpaceX. I'm going to guess that we're going to be close to, roughly 50 billion for either one of them. The problem is that a lot of the people that are going to be looking to buy have such enormous gains in their existing positions that I think that it almost might force them, if they don't have a big enough cash position, to then go on margin to take cash out, which then can create even more of a disaster. Because I do think that regardless of anything, as much as I believe in SpaceX, and I do think that in the long run, it will be one of, if not the biggest companies in the world.
I think we're already at all-time highs in margin debt.
Yeah. So my point is, come 6 months from now, when the lockups on a lot of these are over, I think that you're going to be selling. You're going to see selling that's going to beget selling. And I think that's going to be such an enormous weight on the market that it could force another set of margin calls, which, again, I don't care what you own. I don't care if it's the miners. I don't care if it's silver, if it's gold. When they throw the baby out with the bathwater, it all sinks.
Yeah, but I don't think, and I could see that. We haven't seen a watershed event like that maybe ever.
Big capital raises don't create wealth automatically. They often reveal where excess optimism already exists. Andy Schectman's argument suggests that margin, not valuation, becomes the real stress point once lockups expire and liquidity tightens. That distinction matters because forced selling ignores fundamentals and punishes patient investors alongside speculators. Wealth protection means preparing for correlation spikes before they arrive. Next, Andy Schectman walks through the exact timeline when institutional money shifted from bonds to commodities, and why retail is always 18 months behind.
Where you have that kind of volume that gets sucked out just like that.
I believe that there have been several employees of SpaceX who have been made like millionaires overnight, everything from cafeteria workers to janitors to people helping with the steel infrastructure of the rockets that when they
4,400, Michelle, 4,400 millionaires were made from SpaceX.
All right. Well, so when these guys get the opportunity to sell, there is a lockup period for them, but when these guys get an opportunity to sell, I'm sure they'll at least take some money off the table.
I would tell you that, I would tell you, and again, I am a betting man. There is no question. I don't care. Listen, I don't care how good of a company that you work for, that you own. It's almost irresponsible of you that when you have the opportunity to do that, to take some of those chips off the table and just diversify enough. Look, you know how many times my father-in-law was at Bear Stearns since 1980 before it went under. And every single time when he was in the, he had to buy into the executive pool, whatever it was, every paycheck, X amount of money went into this executive compensation plan, whatever it was, to buy Bear Stearns stock. Every single time that his came due, he sold whatever the max he was allowed.
He's a lucky boy.
The ones that didn't, you know what they got?
Squadouche.
Stugats. Yeah. That's it. And that's the point. It's always, always good, no matter how good anything is. I mean, look, even us. I mean, you absolutely believe in silver and in gold without a doubt. But I know that you have other assets in other places that, not saying that gold and silver are going to fail, but you at least have other assets that if you didn't want to access that.
Richard Russell always said, avoid the big loss.
That's it.
The fastest fortunes in history often become the slowest exits when concentration replaces discipline. This is where Andy Schectman's thesis shifts from market opportunity to survivability, because liquidity events tempt investors to mistake paper wealth for permanent wealth. History rewards those who harvest gains before narratives reverse. Missing upside hurts less than becoming trapped when everyone runs for the same door.